And also, my Apple case study. Before I cover the general market, I want to walk you through this Apple trade. And the reason I'm calling it a case study is because I'm intentionally continuing to trade this stock with several different trades, because I am trying to play out this pattern, which I am calling a bottom pattern, based on my years of trading and how stocks generally form a bottom pattern. After a long decline, they hit a bottom, they form some kind of, well, this is a perfect bottom. The bottoms might be different. It might be a V bottom where it's a big spike, just hit it down and it immediately spike back up and never form this bottom like this. But generally, this is how you would like a bottom or top to form, because it happens slow enough for you to really get a grasp on what's really going on. But Apple wasn't along with almost about a 1 year decline. Finally found some kind of support and hung in this little channel for a while, and then broke through that channel, came back, tested this level of which was now support, it was resistance, and now jumped back up. So based on what I see, I think Apple has bottomed out based on a technical pattern. Ultimately, with everything in trading, you really don't know. You just trade based on your best rational judgment, and then ultimately the stock market and the stock will let you know if you're right. And so I started off testing out this, when it was right here at, which was resistance at that time. I started out with, I think credit spread or strangle, I can't recall. Started here with, vertical credit spread on 726. When was that? So yeah, I started with credit spread, and then, then I remember I was at this junction of resistance, and I realized, what? This is an important junction. I have no clue, where the stock is going to go at this point, and I didn't feel it was safe enough to be in a directional trade, because I was in a bull put credit spread. I didn't, that's pretty much I only profit if stock goes up. Since the stock was at resistance, I said, well, this pattern could hold out and it could go back down, which in case I would lose money. So I said, well, let me change that to a strangle. So I changed that to a strangle. We got lucky with some news splurt, and I wound up making $1,800 profit on that strangle. So from there, that's profit I didn't expect over and above or what I would have, anticipated. So I said, well, let me use that profit to, make some gambles here and be a little bit more riskier than I want. That profit took my account close to almost, it was 60-something% because I had another cash security put open. So it really boosted up the account, which would have been great if I had held on to that, but I did not, because I have since lost all of that profit, which I am okay with. Everybody has their own opinion. Some people might say, oh, that was stupid, that was a waste. But honestly, I'm okay with that, because even still, my account is up 43. That's like almost double, triple what, most professionals get. So either way, I'm still in the top echelon of all traders. I'm not going to complain. I am not going to be greedy. All right. So looking here, I made an $1,800 profit. I'm not going to break out my calculator, but what I did was subtract all of my losses plus my gains from this $1,800, and overall I lost $29 on this whole Apple case study. Starting with I actually didn't start with my credit spread profit, because if you consider my credit spread profit, I'm actually profitable on Apple so far with this batch of trades, but I did not consider this credit spread profit because I wasn't being super aggressive at that point. It was just my usual traditional trading. I started right here at the $1,800 because this is an unexpected profit. And I explained in the last few trade recap videos I was going to be a little bit more aggressive. So anyway, I subtracted all these numbers below that, and all of those added up to be a $29 loss. So at this point, this strangle right here is going to expire worthless. I'm not going to close it out. If I close it out now, I'm only going to get like $24. It's not worth it. I pretty much ran out of time. And I bought myself 16 days, which I thought would be enough, but it seems like it was not. Retrospect, maybe I should have cashed in, because at one point the put was fairly profitable on this downturn right here. It's essentially just a pullback, normal pullback, nothing crazy, just a normal pullback, except that it happened such a long period of time that the strangle could not work, because the put was profitable and it was almost in the money. It would have been up to 480, would have been in the money. And Apple, the lowest close was here at 487. So it needed to go down just like $7 more before it was in the money. and then that put would have started really making some money and pulling the weight of the money I lost on the call. And as you know, the last few days, Apple has been up. So now that put option is out of the money. I have a few days left to expiration, and it doesn't even look like my call option will be in the money unless something crazy happens in the next few days where Apple goes up to 530. It's up at 498 now. So $30 divided by 498. Apple has to go up like 6% in the next 2 days. Possible, but not likely. So I'm not even expecting that. So anyway, if that happens, then we'll make a little bit of money on the call option. But I am anticipating me losing all my money here on this strangle. And so at that point, I pretty much lost all my profit. So I'm like, and I'm back to normal. It's nothing. I was just going to cut my losses, just move on, just consider it a failed case study. But I said, I'm not willing yet to give up on this Apple technical pattern that I think is a bottom. I don't want to do another strangle. That'll cost too much. If we come here to an option chain here, it's going to cost too much for me to do another strangle, and then the $700, $800, I don't have any more profit to risk. And so I said, I don't want to do that. But what it looks like right now, based on the chart, is that Apple is going to head up here. At least it looks like it's heading up in the next few days. The pullback is over. It looks like it's now starting to cross up here. So tomorrow, this is purely speculative, all right? No templates or anything like that, purely speculative. I'm not even going to justify this. This is purely speculative for me. And so what I decided is, I want to continue playing out this pattern. I don't have any more profit to risk. So what I'll do is go back to my usual 2% rule and risk roughly 2% of my total trading account. So this is going to be around $300. Risk doesn't mean invest, so risk. And I could invest at 2%, but I looked at, again, options with 16 days left to expiration coming out here. I could do the 530, but again, just what I told you a few minutes ago, looks like a 6% move. Could happen over the next 16 days, but for some reason, I just like the 525 better. It's a little bit further up. They're still way out of the money. These ones are just too cost prohibitive. I just don't want to do that at all. But I could do like a 450, buy this for 450, and then maybe do like a 50% stop loss or 75% stop loss. Probably 75 will work better for weeklies. Weeklies are so volatile, it's so risky, it's ridiculous when trading directionally. I do not recommend it for anybody. I would not teach it, but for me, I'm okay doing this speculative trade. If tomorrow Apple is up, then I might have to come up to 530. It depends on the cost of these tomorrow morning. Today I actually wanted to buy it, but I decided to let you know before I purchased it. Standard, sent out the trade alert, didn't make the trade. So we'll see tomorrow where Apple is trading at, because I might have to come out to the 530, but I definitely want to keep it around that 4 to 6% range as far as how far out of the money I go. So I'm going to risk roughly $300 or $400. That's what I'm looking at targeting. Not 5, but around 3 to 4 is what I want to risk. And I want to just buy a call option about 16 days out. The 9s are too close for me. 2 is definitely not much time. So 16 days is bare minimum what I would take. 23 would be a little bit better as far as time. But, they're going to cost a little bit too much than I want to spend for these weeklies here. So we'll see. Plus these 16 days have a little bit more open interest. So that's what we're looking at for Apple to continue, playing out that technical pattern. I think is bottom. So now what I want to do is look at the big three as well as my current and maybe any upcoming trades I want to make here. I was reflecting on my last video where I was covering the big three and telling you that, if this was a market top and we were heading to another bear market, that you kind of focus on the clues that the stock market gives you. One of the clues is that, it broke through support here, and, I covered some other things. And once I meditated on some more, everything in there was correct, except there's one thing that was missing that I forgot about. Extreme optimism. Market tops are rarely, if ever, predicted by the media. The media right now is pretty negative with things going on in the world, the deficit, the bond buying, all of these things the media is pretty negative on. And it seems like the media is leaning more towards a crash than they are towards a bull market, And at least the last 2 bear markets, even in the real estate bubble, there was extreme optimism. People did not think the stock market could fall in. They just thought the stock market could keep going higher. Same with real estate. They thought real estate was just going to keep going up. That extreme optimism was present. It's always usually present when a bubble hits. Same with gold. Actually, gold was the next bubble. If, people's memories, short-term memories are pretty, not that good. But, people may not remember. But I remember people were like extremely bullish on gold here. Even I had church members coming up to me talking about gold all the time because they know I'm a trader. And I was like, it's gone up too far. This is only a 5-year chart. And I was like, the long-term chart of gold, it's actually, the return is horrible. But people were just, focusing on the present day, and they were like, it's going up, it's going up. And I was like, well, that kind of move is unsustainable. It's bound to crash eventually. Don't know when, but, just hedge yourself, protect yourself. Don't think it's going to keep going back up. And gold started falling here about 2011, and that's been in about a 2-year downfall. Look to have bottomed out fairly recently. If I zoomed in to like a 9-month, I can't remember if I talked about it in the 50K, but I remember talking about with somebody about the exhaustion gaps. It was 3 exhaustion gaps, and the third one is it's called an exhaustion gaps, downward gap. So here's one, here's another one. Oh, here's the third one right here. And I said, well, that's generally what happens after stocks bottom out from a certain price movement, both either up or down. And then it has since turned around. That's not always guaranteed. It's like any other charting pattern. It's best case scenario, but this one seems to have worked out. So it looks like it's at least temporarily formed a bottom, and I don't know how long that will last. But anyway, the point I'm trying to make is that extreme optimism was present there, even with gold, and it's not present here with the S&P. So I'm not even sure now. Once I thought about that, I was like, I'm not even sure if this will be a market top or not. I think the market may go a little bit higher based on that one fact. Technically, it doesn't look like it will go higher, but based on the fact that extreme optimism is not present, yeah, it may fool us technically and then continue to go higher. And then if that extreme optimism ever does become present, then I will be overly cautious. But again, nothing is guaranteed. Nothing is 100%. Nothing ever happens exactly the same way. So maybe this is a market top where there's not extreme optimism and there's just a lot of bad stuff going on that eventually catches up with the market and does fall. Honestly, we never know. We just have to trade what we see, not what we think we're going to see. And right now, I see the market kind of bearish, but looks like it's trying to make some headway back up. But we'll see what happens when prices get closer to the 30-day moving average. If they get close to the 30-day moving average and go back through it, then this will just look like a really strong pullback, and then we will just wait till the market recovers a little bit more and then start trading again. Okay, so moving on here to the one trade I'm considering making. First, let me cover the account performance. Considering I'm going to lose all my money on the Apple Strangle, I'm up 43%. If I place another trade on Apple, I'm going to risk roughly 2-3% of my account. So it looks like even with that directional speculative call option, I still should be up around 40% worst case scenario. Hopefully, you shouldn't use hope in trading, but hopefully that trade works out and then I can jump this account up, to the mid 40s, closer to the 50s, depending on how that call option plays out. I will at this one time make this speculative trade in my long-term account because I'm considering an adjustment to my strangle. And I will just buy one leg of the strangle, which is a call option. If I need be, I can add on a put option later. I don't anticipate adding on a put option, but if need be, I can. So for this one time, I will make a directional trade in my long-term account. And that account is actually at 48%, and so it's doing better than the short-term account, and that gives me a little bit more room to play with too. Because 48 is pretty good for the year. Actually, I'm happy with 40. Better than last year and still upwards close to 50. So I'm not going to risk all 8% doing crazy. This account is still, the slow and steady account where I don't try to be too gunslinging, gun-ho and stuff. Usually, if you've been following me for a while, I'm not that aggressive here in this long-term account because this is the account sort of like you're retired, you're living off your income, you're just trying to protect your wealth, accelerate wealth creation, but also protecting your assets. So you're protecting your assets, and it's a kind of slow and steady, get rich quick approach to building wealth. You're not really trying to double your account in a year like you might in your short-term account. So that's the account performance. The one trade I was talking about, I was thinking about making here is USO. Thinking about getting back in USO as a cash secure put based on the fact that it looks like it's found some support here or a level I can trust. It's still above, before forever it stayed in this little short channel here. It is now formed, it surpassed that channel. It is now formed what I consider a new support line here. If we come out to a 5-year chart though, you will see where that new support line is in relation to the long-term channel here is $40 and $31. So the long-term 5-year weekly channel is between $31 and $40. So somewhere in between that, about $35 would be the midpoint of this long-term channel. So it's still within this channel. So it's still, I'm fairly comfortable with it. If something happens, I get a sign because it's behaved rather predictably the last 5 years. But what I'm trying to do is now drill down to a shorter time frame to see how it's acting present day. And so present day, it's formed this level of support around $36. So what I'm thinking about doing is doing another cash secure put here. Let's come out to USO. And I'm thinking of, I just realized here this, sorry, give me one sec. Sorry there, I just wanted to make sure the entire trade tab fit within a recording window. But mainly what I'm looking at for USO is making another cash secure put right around the support line, a little bit below. That looks like the support line is held. It actually look like the stock is making higher lows. Gosh, I hate when I do that, when I mess up drawing a trend line. Okay, so let's draw this trend line. So you can see just a little slight angle there. It's making higher lows, so it looks like the stock is going up. So if I place it below that level of support, there should be a high chance that I won't get a sign. But even if I get a sign, remember $35 is like the midpoint of that long-term 5-year channel. So if I place I was looking at like a 35.50 here, cash secure put, way out of the money, 44 days left to expiration. Gives me plenty of time for the trade to work out. $38 divided by 35.50 puts the return on cash about 1%. So not the best return on cash, but good enough. I could come at an even number in 36. Let's do 0.49 divided by $36, and that puts it at 1.3. I'm not going to squabble over a few percentage points. Actually, I feel safer with the 35.50. Is actually below that support. So that 35.50 would be not way here. It'd be about down here, even below where prices have recently found some level of support. So it's actually below support. So I feel safer with the 35.50. There's only 44 days left to expiration. It will add about, it's a 1% return on cash. And I have to figure out how much money I have to sell how many contracts. So short-term account, I've made roughly, actually let's scroll to the bottom here and I can show you. So I've made a profit of close to $5,000 in this account this year. So I can pretty much look at where the account balance is now, 17,000. How much of that I want to put to work? Roughly 90% I'll put to work as far as cash. 95%, because honestly, I don't place that many trades at one time, risking 2% per trade. 2 or 3 trades out at one time. I only have like 6% of my account out at one time. 95% is always in cash. So I can risk roughly 90 to 95% of this total account balance on that cash secure put. So those are the rough calculations and how I do it. I don't, put anything to a spreadsheet. I just kind of do the numbers quickly in my head and go with that. I try to keep things pretty simple. But that's what I'm thinking about doing, is going back to USO and another cash secure put, because it's now stabled out. At first, I didn't want to do it here. Broke through this level of resistance. I didn't know if it would keep going up. What would it do? But it looks like it's stabled out a little bit. Found some level of support. I can feel safer now. Now I can come back in here and jump back in here with another cash secure put and then put that cash back to work. So those looks like the only 2 trades I'm looking on making. USO cash secure put and another trade on Apple to continue playing that bottom. And unless something changes, those will be the only 2 trades I make until we figure out what the general market is doing. I feel safe with just those 2 trades, because the general market, it's not all over the place. It's just doesn't know if it wants to go up go down, or what is it doing? So I just want to wait till I'm a little bit more secure and confident in the general market. Even, just doing a quick scan of my watch list and all the big name stocks, Google, IBM, Walmart, McDonald's, it's just, things don't look good chart wise. Amazon and Netflix, they are so, but they're not like beautiful charts. Netflix actually is slow and steady going up. But that's about the only one. And I don't actually trade Netflix that much. Netflix, I have trouble getting a gauge on. For some reason, I have trouble with Netflix, but Netflix looks okay. Maybe a bull put credit spread might be okay on that, just based on the stock's direction. Let's see. Let's change it to the verticals here and look at the open interest. So the open interest looks fairly healthy on that. So that actually doesn't look bad. Stock, as far as the bull put credit spread, just based on the direction, based on the fact that it's continuously going up, it would be your selling time. You could use a template. It's not satisfying any PR recently, but you could plug in Market Club to see what Market Club's trade triangles look like. Or you could look at it from a pure technical standpoint. Just look at the chart, look at what it's doing, look at where it's at on the chart and say, where do I think the stock won't go to, in the next 16 days, the next 23 days, or the next, 30 or 43. Looks like, the 23 days weeklies don't look good as far as open interest. Neither the 30 and the 44 is okay. So you either have a choice. You can go 44 days out, or you could go in 16 days out. So that actually looks okay. That might be one I paper trade. I don't want to risk any real money right now. I just came off vacation, so my brain is a little slow. I'm a little rusty. I want to jump in a bunch of trades. Apple and US are the only ones I feel comfortable right now, but this may be one I paper trade on the side. So that's all I have for you. If you have any questions, let me know. And it's good to be back. Good to talk to you again. And so you take care. I hope you have a great rest of your week, and I will talk to you soon. All right. Bye-bye.